This Week in E-commerce, episode 119. Mal Chia here with you for our last recorded episode of 2025. This is going to be a solo episode as Alex is in Japan skiing the slopes for a well-deserved holiday. This week, we're going to have something a bit special, which is our year-in review. Now, this isn't just a regular year-in review because it has been quite a year. This is a year when multiple forces have hit retail all at once, it seems. And it's punished the same thing, fragile business models. And it feels like things got harder than ever before. And it really did, for a variety of reasons. So we're going to be counting up from the most important headlines which have impacted retail this year. Starting at number 5, we have Shein and Temu have rewired consumer value. Now, this has probably been the most impactful for a lot of retailers because this year we've seen massive growth in the Chinese marketplaces Shein and Temu. 4.7 million Australians bought from Temu, which is up 24% year on year, and 2.6 million bought from Shein, which is up 27% year on year. So where does it stand? Shein is now bigger than the Iconic in Australia, and Temu is right up there with Amazon. Combined, was $1.3 billion in annual sales growth from 2024. And this was driven off the back of a lot of advertising as well, with both reporting roughly about 50% an increase in advertising across digital media in Australia in just the June quarter alone, with Temu up about 20%. So it shows that Temu and Shein are no longer fringe players anymore. These are multi-billion-dollar businesses who are operating locally. And a few of them are really starting to make waves here and really trying to establish a bit of a beachhead in Australia by partnering with local fashion brands, which Shein has been doing. But more importantly than that is that they have been resetting anchors, in particular price anchors. They're no longer stealing share from local retailers like how they did in the past, by how other brands did in the past. They're doing it by changing how we perceive value in the market, which in this case is what we think cheap means. They fundamentally changed what it means to buy a low-cost item, and they've normalized ultra-low AOVs and endless novelty with thousands and thousands of new SKUs launching each week, and also normalizing a 2-week wait for your products as well. In addition to that, they've really made browsing entertainment by making the whole experience on their site almost fun, by going in there and being able to gamify and experiment and do a lot of different things to keep you on that site. And the brutal truth for most retailers is that you can no longer compete with them. Instead, you're compared to it. When you think about products now, an $89 dress, which you could buy from, let's say, Zara, you can find something equivalent to that for $12 on Temu or Shein. So that $77 difference is quite significant. And you start to think, is it actually worth the difference? Sure, the quality may be better and it may be better designed, but is that really worth that $77? Particularly if you're looking for something cheap. So you can no longer compete just on the fact that you've got a better quality product. It needs to be clearly better. It needs to be obviously better. And the retailers who are getting squeezed are the ones who are in the middle, who can't compete on price because they're at a much higher bracket, but also don't have enough of a competitive moat to be able to craft the story and experience to justify that premium price point relative to Shein or Temu. And that middle is getting squeezed. So you either need to be in two areas. You either need to be at the ultra cheap level and compete directly with them on price, which is very hard to do unless you're big and you've got the margins to do it. Or you need to compete on being premium, which a lot of brands currently aren't doing. If you're not doing that, you are right in the kill zone. You're right in the firing line of where these two brands are and what consumers are looking for during the cost of living crisis. And it's all about that value perception. Do customers perceive that increased price and the value in your product and trust that you can deliver on that? Number 4, the AI hype curve has snapped. This last year, we've seen a massive increase in scam stores, AI-generated creative, AI chatbots, which are all leading to trust erosion in the industry. And brand trust has been the most important thing about why you would choose to buy from one retailer over another. But when you're seeing more and more come into the marketplace, that trust is going away, not just for certain brands, but for the entire industry. This year alone, e-commerce fraud losses are projected to increase to $48 billion, which is up 16%. And chargeback volumes are expected to reach $261 million, increasing to $337 million by 2028. And Australians lost over $27 million from online shopping scams this year and counting. So AI hasn't just broken e-commerce, it's broken credibility and trust. It's broken our ability to go to any website and trust that this merchant is legitimate, that we are going to receive those goods in a timely fashion and what we ordered. And AI has sped that up with the rise in AI-generated storefronts, with fake founders, fake products, stolen creatives, deep fakes, and obviously no product which actually arrives to the consumer. And they pop up and they disappear as quickly as they can. Because AI has made it incredibly cheap for stores to look legitimate. It's made it so cheap that they pop up all the time now. And it's so easy to get fooled. It's not just those with an eagle eye. It's almost everyone who's seeing more and more of this. And while the platforms have responded somewhat, with Meta and Google both tightening creative policies, Stripe and PayPal being more aggressive in terms of who they're going to allow on their platforms, it's still not enough. And what we're seeing now is a response from consumers, with consumers now being more skeptical and also being faster to dispute if they don't receive things quickly. And the explosion in chargebacks, which is primarily friendly fraud, is increasing, with consumers who aren't trusting that things are coming, reporting it, leading to a chargeback to the customer, chargeback to the merchant. It's unintentional, but it's happening because they don't trust the system anymore. And this divide of using AI means that we've also seen more and more content being created, with a lot of brands now relying heavily on AI to generate more emails, more ads, more product descriptions, which is leading to a homogenization, because everything is now starting to look and read the same. And in an industry where differentiation is everything, this is a killer. Now, the best brands, though, are using AI in a really good way, and that's to make better decisions. They're using AI for forecasting, segmentation, operations. They're not using it to take their creativity away, because AI is now punishing those brands without taste or judgment or good governance, who are just out there pumping out AI without any thought, without ensuring that this is actually going to create a connection, an emotional appeal to their customers. So if your entire creative output can be replaced with AI, you don't really have a brand anymore. You just have a Shopify store with a logo. And this continued erosion in trust means that the weak brands who don't take up the challenge to express their own creativity, their own point of view, are going to fail. Number 3, retail Darwinism. And this year we have seen a huge increase in the number of retail brands who have gone into administration. Every month, ABS data continues to show more and more retail brands falling into administration. And a lot of this is through a number of changes. One of the big changes is the way in which consumers shop now. 40% of Australians are now shopping weekly on online marketplaces, including Amazon. And also the consumer preferences are shifting very rapidly, as we talked about before, to those cheap online retailers or people looking to trade up to a better option. And to show how this works, there's really no two better examples than Mosaic Brands and Labubu. Now, first onto Mosaic. They're a brand we first talked about in 2024 with the struggles they were experiencing. The owners of Noni B, Miller's, Rivers, and Katie's, they've died a very, very slow death, which has very much accelerated in the last 6 months from the end of 24 into 2025. They're a business which were relied too heavily on malls, particularly malls with declining foot traffic, which also led to high fixed costs and a lot of inescapable leases as well. But more important than that was poor brand relevance. While all these brands were kind of household names, if you were more than about 30 years old, you've probably seen them before. You didn't really have a connection with them. and they lost touch with who their customer is. And they themselves became more homogenized as they lacked that positioning around who they were actually speaking to. And Mosaic was also slow to adapt to online retail as well. And when they did it way too quickly and overcapitalized. And even at the scale they had, they lacked flexibility, they lacked that operational excellence, and ultimately, they lacked the cash flow to be able to maintain the business as they accrued more and more debt. And this debt ultimately led to a lot of creditors around the world, factories in India, supply chain and logistics, staff, landlords, deeply, deeply out of pocket because they weren't able to move fast enough. They kept doing what used to work and assumed everything would be okay rather than adapt quickly to the new normal. On the flip side, we have Labubu, the number one most searched term in 2025. If you look at the curve on Google Trends, there's a very, very steady rise and steep rise for Labubu searches up until the middle of the year. But since then, it's been eroding very, very quickly. Labubu grew on social media from influencers clipping their really cute creatures onto their bags and wearing it around. It was driven by social media through TikTok, through Instagram, everywhere. Also, they had a collectible model as well, with the mystery boxes where you weren't sure which Labubu you were going to get, which led to scarcity, an artificial scarcity which drove up resale prices. Resale prices at their very peak were hitting about X, if not more, and people were going crazy for them. There were insane lines at Labubu vending machines, Labubu stores, anywhere you could get Labubu. And I know for many episodes, that's what we talked about quite a lot as well. But as quickly as that hype came, it disappeared. Resale collapsed, and now PopMart, which owns Labubu and was once valued at over $5 billion, when you walk past their stores, there's hardly anybody in there because people have moved on to the next thing. So while Labubu were very quick to grow from hype, that hype is also what killed it because they were built to spike. They were never built to last. And that's the fundamental difference. They had a business model which is all about capitalizing on what's here and growing as fast as we can with no thought to how do we actually sustain this? Do we actually have profitable, sustainable growth for the long term? So as quickly as it came, Labubus are more or less gone and consumers have moved on to the next thing. So not only do we have slow death from denial, you also have that fast death from hype as well. It's the same lesson, but at different speeds. Because both of them failed to answer the fundamental question which every retailer needs to ask, which is, why do we matter? Not how well are we known or are we trending, but how do we actually matter? Because your legacy isn't enough. That hype isn't enough. Hype has a half-life, and that half-life in this day and age on social media is rapidly shrinking. That scarcity, which grew them in the first place, could have been a moat if executed properly. But instead, they saturated the market with more and more and more Labubus and tried to grow really, really quickly. So you need to ask yourself, with all the other brands which have collapsed in the last 12 months, how could they have avoided that if they had thought more consciously about meaning something to their customers and building a profitable, sustainable business model? Number 2, the death of the D2C fairy tale. 2015 is over, as is everything pre-2022. All those norms which you grew up with, where all you needed was a Shopify store and spending a lot of money on meta ads in order to grow, is out the window. Meta CPMs are well above pre-2020 norms. Amazon is now over 40% of all US e-commerce, and physical retail still accounts for over 80% of total retail sales globally. But what we're seeing is the increased competition, which is coming to D2C, means that old model, where you just have a store, run a shitload of ads, and expect to grow, can no longer work. Not by itself anyway. And while it may work in the short term, it does not have sustainable legs because the cost per acquisition has gone up so dramatically, which has made acquisition incredibly difficult and almost unsustainable beyond a certain point, which has led to this addiction to promotions. This year, we have seen year-round promotions, it seems, pretty much from when Black Friday finished in 2024 to monthly promotions for a number of brands in order to be able to move product. And the only way they've been able to move it is by discounting, which has eroded what their brand value is. And with infinite options as well, returning customer rate continues to drop unless you have something which is generally sticky. And the margin pressures from cost of living, increasing utilities, rent, labor costs, all of these means that even if you are making the same sales, you're certainly not making the same profit. So this year, we've seen a lot of those D2C darlings like Gymshark, for instance, really start to expand out from where they used to be. While D2C may still drive a large part of their revenue, they are now looking to diversify. And they're doing this by opening stores in new markets to break into new countries, but also expanding into wholesale as well and going hard into marketplaces, because it's no longer enough to just be a single channel. You need to be omni-channel more than ever in this day and age, because it's about risk management and diversification. Amazon, which used to be an optional for a lot of brands, isn't anymore. It's essential because of the number of customers who are now shopping on those places. You can't afford not to be on Amazon for certain brands. And physical retail is almost a trust barometer, a way for people to see that you're legit, to trust your brand, and then potentially buy online from you because they know you're real. And stores, the physical stores themselves, are no longer just about the transaction. They're about those trust signals. They're about giving you a physical presence which builds a perception about your brand and legitimizes you. So D2C in no way, shape, or form is dead. It's just that fantasy that you can build a business just on D2C and become a multimillionaire just on that alone is going to be incredibly hard to do. It's not impossible, but it's harder than ever. So brands really need to start to think about how they're going to shift out of this D2C only mindset and treat this as an evolution, not as a failure of the D2C model, but as a starting point, that this is the natural progression to start to look at how do we expand out and reach new audiences through different channels. So the brands who are struggling and still trying to make 2019 work, pouring more and more money into digital ads and hoping that everything is going to come back to normal, I don't think you're going to be seeing many of those around, which brings us to our number one topic of the year, which is the US tariffs, the structural reset we really didn't ask for. So what happened? The Trump administration earlier this year eliminated the de minimis threshold, which previously allowed duty-free imports into the US under $800. But what this has led to is a tariff on goods coming into the country of anywhere from 7.5% to 130+%. And this is on hundreds of billions of dollars of imported goods, which US customers used to buy from other countries, including Australia. And while the rationale behind this was to stop the low-cost imports coming in from Temu and Shein, and it did work to some extent because Temu's monthly active users fell 51%, Shein's dropped 12%, it also impacted other countries as well, who really didn't ask for any of this. And Australia is no different because our retail sector has been incredibly hard hit by this. This has killed demand for Australian goods because importing now from Australia means that $50 t-shirt is now going to be potentially $80. Or if it's coming from China, because that's where it was made, the country of origin, it could be over $100 now for that t-shirt. So if you're an Australian brand making product in China and selling into the US, you got absolutely smashed this year. Not just because the cost of selling your goods into the US was so high and demand disappeared, but also how were you going to respond to this? Were you going to ship directly from China and eat the tariffs from there? Or were you going to ship to Australia first and then to the US? And even how were you keeping up with the ongoing changes to the price structure as well, as the tariffs kept shifting day by day and you weren't really sure what you needed to do because the information was hard to come by? Because we were also unsure when or if they were going to happen. It was on, it was off, then it was on again, then it was off again, and finally there was a hard deadline, and here we are now. And the Australian brands had to respond, and there weren't many options. The most common one was to look at opening a US-based 3PL and do that fairly urgently. And some brands were able to stand some up very quickly in time for Black Friday, but the vast majority weren't able to. Some were able to get warehouse stock locally over there to avoid tariffs on every shipment. And that was good for the most part. But again, smaller businesses have been particularly hit hard by this. But also the constant adjusting of prices as well as the policy change means that margins continue to erode, even if you were able to sell into the US. Now, some brands were able to increase their prices and offset a large part of the tariffs, but a lot of brands weren't, and they have had to pull out of the US market entirely. And while this affected everyone selling into the US, it most affected the SMB market. You know, those brands doing 5 million to 50 million who were dependent on their China supply chains, but also, more importantly, didn't have the margin power, didn't have the margins to be able to command a higher price, or even the brand to be able to command a higher price as well. But those bigger brands who had the margin, who diversified supply chain to not have everything come out of China, or had the capital to be able to go and set up a US 3PL very quickly, were able to survive. But also premium brands as well, who could justify the high prices, but more importantly than that, actually had a brand that customers in the US still wanted, even though they were going to be paying a premium for it. They were able to survive. Brands like Black Milk, Maison de Sabre, because they offered something which their customers in the US still wanted from them, and they still look like a very attractive option. So the tariffs, they didn't shock the system. They were really a stress test of it to continue to show who actually was able to weather this storm versus those brands who were going to crumble. Because expose those who didn't actually have any real pricing power, but also who didn't have a handle on their operations to be able to navigate this storm. Because as the cost started to increase and demand became so fragile, there was no room for them to pass it on. Tariffs were the number one story because it was a reality check. It was a reality check that removed the subsidy that was keeping their business models alive, and it exposed a lot of brands for probably who they really were in the first place. So that's it. Those are the top 5 headlines for the year. Would love to know what you think of them. Hear your thoughts, either now or in the new year. But if you look through all of them, you can see how the dots connect, from the resetting of what consumers expect value to be, to how trust continues to be eroded through AI, to the slow and fast deaths of those bigger corporate retailers versus ones like PopMart, and how they died such a different death, but still based on the same thing, to the DTC fairy tale being net broken, and also finally the US tariffs. You can see how brands with weak retail models weren't able to survive this year. And those who were able to survive, it was clear on what they did really well. They knew who they were for, they knew why they mattered, and they knew how they were going to make a profit, even if sales were going to be down. So that's all we've got time for this year. It's been a pleasure having you listening to us each and every week. Alex and I will be back in January with our 2026 Crystal Ball. We've got 4 great guests lined up for Jan, and we're super excited to have you there. In the meantime, enjoy this time with your family. Enjoy the holidays. Keep innovating, keep growing, and keep selling. And we'll be back in 2026.